I'm delighted to say that this session is also being live streamed, so we'll be joined by people on the web, hopefully, watching Sarah and Lydia. I just want to do a few housekeeping things first. There are no fire alarms planned, so if there is a fire alarm, it's real and we need to leave. And if you need the bathroom at any point during this session, it's just out those doors, straight down near the lift. So hopefully you'll be fine. There will be questions and answers at the end of this session. You can do that in the traditional way by putting up your hands, which we encourage at the PLSA. But you can also submit questions via the app, which hopefully you've all managed to download by now. There will, in one of the sessions, be a live poll which you'll be able to vote on as well. So that will require the app. We don't allow shows of hands for that. So, as I said, I'm delighted to welcome Lydia Fearn, Head of DC and Financial Wellbeing at Redington, and Sarah Smart, Independent Trustee, SmartCats Consulting. Without much further ado, I will hand over first to Sarah.
Thank you, George. Now, I'm going to apologise if any of you came here for a bit of an afternoon snooze. It's a bit bright in here, probably for that, compared to the plenary. I can't promise it's going to be exciting enough to make you wet your pants and go to the toilet, but what my intention is to give you a bit of a call to action. Because it's my belief that whilst we've been talking about DC for a number of years now, and thank you to the PLSA for continuing to put it quite far up the agenda, we're still way behind where we need to be in our thinking on DC, and I think we really need to up our game on this. So as is my wont, I won't be giving you an easy time. I sit on a few boards for a living, and on those boards, a question that I love to ask, which some of you will know, is what are we trying to achieve, and how are we going to measure if it's successful? We shouldn't be fooled that if we're doing lots of stuff, we're actually achieving anything. Activity is not the same as achievement. And I think particularly in DC, we really need to ask ourselves, is what we're doing going to deliver the best outcomes for our members? And are we focusing the very scarce time that we have on doing that? So how that relates to DC schemes, over the next few slides, what I'm going to do is think about what we actually mean by active investing in the context of DC schemes, how we might focus our very scarce and precious governance time with our excellent trustee bodies that we have on thinking about the right areas, and most importantly, how we make sure we're always thinking about member outcomes when we're thinking about where to focus our activities. So, what do we mean by active in the context of DC? I think generally, when we talk about active management, particularly when we're titled active versus passive, people will think about active stock selection, so active management of an equity mandate, for example. That's one area of active management. Also, active asset allocation. And I think often when people talk about active asset allocation, they might think about market timing. Surely a mug's game. Nobody does market timing, do they? Nobody can win with market timing. Well, active asset allocation done right, done even a little bit right, done even an incy bit right, the results of that can blow out of the water what you can get from active stock selection. So let's not just dismiss it out of hand. But I'd like to add a third as well, and that's active journey management. And I think we're all starting to be familiar with talking about journey management in DB, but we're not really talking about it as much in DC, and certainly not throughout all of the phases. And so there's two areas I want to look at in that. First of all, the active measurement of the achieved returns versus target, and we'll go on to about setting the target returns as well. And secondly, the active adjustment of the journey plan compared to make sure we're reaching our desired goal. Just perhaps an aside on the expected return target for the plan. I do look after, I sit on a committee for a GPP scheme as well. I think we're talking mostly about trustee schemes here. But I did ask a GPP provider if they could explain to me what their objective was for their default fund and their GPP plan, the investment objective. I wasn't able to extract an answer, which I thought was rather depressing. But there we go. I know we don't have that issue with any of the DC schemes in here. So how do we think about these different types then of active management in relation to a DC scheme? What I've set out here is where I think we should best focus that scarce governance time in delivering the best outcomes for members. And I don't hope any of this is a surprise to any of you. First of all, let's try and get members putting more money into the scheme. Secondly, let's try and get them to think about what they might do with it when they retire and tell us, because that will help us design an investment strategy for them. But once they're doing that, and we're getting that from them, let's spend some time thinking about asset allocation. Most importantly, I think, de-risking at the right time. I'll come back to that, not too early. De-risking into the right assets, and that comes back to the members telling us about what they're going to do. But then getting the growth phase right, and I think this is a really underexplored and area where we really aren't doing our members as much justice to our members as we could be, or helping them to deliver, to get the best outcomes that they can. Only then, if there's any time left, which there usually isn't, might you think about active manager selection. And I've put at the end, and I'll come back to this again, I know it's an investment conference, but I want to mention data and admin, because it's such an important part of DC, and it needs a good chunk of governance time. And if you haven't got data and admin right, anything you do on investment, again, could be completely for naught, as they say. Okay, here's a slide that I hope might look familiar to you. Looks a bit like a typical kind of flight path, journey plan for a DC default fund. There's three things I want to say about this slide. First of all, I don't think it's very active. I think generally what trustees are doing is setting a flight plan like this and then setting and forgetting it. And actually, it doesn't look hugely different to what we've been doing for the last 20 years. Maybe that's the right thing. Maybe it doesn't need to. George Osborne threw us a bit of a curveball a few years ago with freedom and choice, and trustees generally changed a bit of the allocations at the end. Actually, there are still some trustees who haven't changed what's happening at the end of their journey path, despite that happening 4 years ago now, so maybe more. I can't remember dates. I'm getting old. Secondly, I think flight plans like this are de-risking too early. And we know why. We're all terrified that there'll be a few members who are exposed to risk assets late on in the journey, and they'll suffer really badly from a fall in the market just as they choose to retire. But our reaction to that is that we are depressing the returns for all of the members to protect those few. And I'll put the question out to you, if we're really acting in the best interests of all of our members generally by reducing returns in that way. Thirdly, and this comes back a bit to data and admin that I mentioned before, in most schemes, the way we've set this up means it's really difficult to change it if we want to do something different as we go through the path. And so actually, the admin issues, the data issues, are really constraining what we can do within our investment. Lifestyle switching is a really area that is prone to error. And if you're not already doing lots of audit testing to make sure your fund manager or your provider is doing it right, then I suggest you do. But it's already prone to error. And then if you start chopping and changing what you're doing investment-wise throughout the path, you just bring in more risk of error. So why would we want to change if we're just going to have more error? Well, because we can do better things for members. And maybe there's something else we should do with our admin to facilitate that. So here's another graph that hopefully is not too surprising for you. My rather amateur searching for investment graphs on Google didn't throw up anything too earth-shattering, so none of them are too different. So often this graph is kind of used the other way around as the thesis behind why we de-risk at the end of the journey plan, because we're worried about members losing lots of money if their pot is very big and they're exposed to equity markets just when the market falls. But I want to use this thesis just to look at the growth phase. So what happens depending on whether you get returns early or late in the growth phase of your DC journey. Now, we know some people do different things in the growth phase. So Nest, for example, we're all familiar in the early years of the Nest investment journey. What they're doing is they're taking quite a low risk, low return investment strategy based on some behavioral analysis about what members will do if they lose money in the early years. The reality is, it doesn't really matter what you do in the early years because your pot's so tiny, the member's pot is so tiny, it doesn't make a huge difference. What matters is what happens in the pot, what returns you get when the pot is really big. And so the returns you get for your member in the growth phase are not stable. And yet we design the investment processes as if they are, and we don't look at the difference as to whether we're getting returns early or late. I know this isn't new news for you, and you might say, well, trustees are already dealing with this. We're designing our investment strategies now to try and reduce volatility and make sure we get a really smooth delivery of returns throughout the growth period. My issue with that is it's really expensive. It's either expensive in the fees you pay to an asset manager to try and deliver low volatility strategies, and we've seen that the diversified growth funds haven't necessarily delivered what we thought we might on there, or it's really expensive in terms of lost equity returns and lost potential, lost opportunity from higher risk assets. And I think there's another way that could work much better for members, is by actively measuring, actively knowing what we want to get throughout the growth phase, measuring whether we're getting it, and then adjusting it if we don't. And this is particularly important in the early years. If we get all of our returns, say we get CPI plus 4% throughout the growth phase, but we got all of that in the early years when our pot was really tiny, the likelihood is we're going to get a lower return than we expected, than we modeled in the later years of the growth phase. What that means is our members' pot will be much smaller than we thought it would be. So we'll happily start de-risking, but our member will only have a small pot, and we're not going to have any chance of delivering them the outcome that we thought. So let's measure what they're getting, what the members are getting, and if they're not going to get enough, we've got to think about what we do about that. Do we need to introduce some more risk? Do we need to extend the growth phase? Do we need to de-risk into different assets? There's a problem, though, with doing all of this. I can't send you all out on your merry way at the moment to do it straight away because, one, are you getting the performance information that you need to actually respond, measure what's going on and respond to it? And two, if you are getting the performance information, is your fund structure set up for you to change things if it's not working as it should be for the member? I am a passionate advocate of target date funds, and I can't actually understand why more schemes, why everybody isn't using them, because they really reduce the risk of administrative error when you try and change things to deliver better outcomes for members. So if you do one thing as a result of listening to me today and you're not already using target date funds, go out and investigate whether they might be a good thing to use for your scheme, whether you could change things a bit more actively and deliver better outcomes for members. I don't sell a target date fund, by the way, so I'm not, plugging a product here, and I'm not allowed to do that. He's not listening, is he? So finally, from me, overall, I don't believe there is any place for being passive in DC. For me, that doesn't mean active management in the traditional sense. Active equity managers, etc., are really quite far down my list of where I need to spend my time. But I do believe in actively setting a target throughout each stage of the journey, the multiple stages of the growth phase, actively measuring what you're getting in all of those phases, and then adjusting that based on what's happened to make sure we're delivering the best outcome for members. Lydia, I'll leave it to you.
Thank you. Yeah, good. Oh, there we are. I've come alive. So Sarah has gone through quite a bit about the DC journey, about the governance, about the whole path. And the bit I'm going to focus on is a bit more around the actual investment solutions. I'm going to firstly consider what passive investing is from the way we look at it. Secondly, think about investment beliefs, how you set them and how you align that to your members and their outcomes. And then I'm going to hopefully bring this to life through some practical investment examples to give you an idea of how you can actually implement it with your own schemes. And in this session, there will be a little bit of a poll, so you'll have to wake up and use your phones. But I'll let you, I'll let you know when that happens. Firstly, I just wanted to have a quick look at the different sources of alpha and what actually passive is. And I was just checking it. Yeah. Passive, the dictionary definition of passive is an investment strategy that tracks a market-weighted index. And this is what we define here under the bottom, a beta of the triangle. So beta is where passive sits. And the next layer up, you've got smart beta, and essentially is putting a slightly active overlay onto an index, so reconstructing an index, but it's still tracking that index. And then quite a lot of people then would move to the top of the triangle and think about a true alpha as active, an active fund where you have an investment manager actively selecting a small amount of stocks from a wider universe. We also include another layer, which is what we've called active quant. And this uses computer programs to choose funds and underlying investments. But the fund manager has an overlay over that modelling and then will change and adjust that modelling depending on market movements. And so the underlying assets will change. But essentially, the computer is still driving the underlying investments. And clearly, when we start at the bottom of the triangle, you'll see that we've got lower fees, lower conviction, and high capacity for investing. And as you go up to the top, higher fees typically, higher conviction from an individual fund manager, but lower capacity, so you might be locked out from a certain level. Now, I could go into the debate between active and passive and argue each case. But however, advocates for active and passive are a bit like meat eaters and vegans, where each of them think that their answer is the right one. So I'm not going to go down that road. And also, we're in the DC stream, we're in the DC space, we are fee constrained, and clearly a lot of schemes already invest in passives and often some in DGFs too. And also, I think focusing only in on those investment solutions isn't necessarily looking at the whole picture. And really, we should be thinking, as Sarah had mentioned, about the membership, about the investment strategy for that membership, and how it translates into outcomes for those members. So here are your members, and they will be split across 5 different generations. And each of your members will have different needs and wants. And research has shown that younger members tend to engage more with sustainability and those sorts of issues. And to be honest, I'd argue that no matter what generation you are, you actually do, a lot of people do actually care about sustainability and ESG. And so when we move into that ESG space, we actually have to make active decisions about how the investment strategy might be shaped, and the funds themselves are moving from passive market cap, that dictionary definition, into something else, which might look a bit more like smart beta or even active quant. So I'm going to focus a little bit more on ESG and how this active approach might fit within your investment strategy. But this is where the polling comes in. So hopefully we can do a little vote and see where you sit on this ESG spectrum. And if you've got a DC trustee position and you've got a hat, please put that hat on now as a DC trustee. And if you haven't, then just be yourselves, that's fine. Just in a moment, I'm going to ask you to choose one of these personas. I'll just describe quickly what each of them are. So firstly, comply. You aim to meet the regulatory requirements and reactive rather than proactive. You're reliant on providers, consultants to address any ESG considerations. Secondly, measure and manage. So you're proactively engaged and trying to manage the ESG profile of your portfolio. You aim to monitor ESG risks, whether it's quantitative or qualitative, and where it's possible to do so. Then you might move along to seek alpha. Are you seeking alpha? Your view is that investing according to ESG is a source of alpha, so it actually creates some extra return for you. Or are you external impact, and you believe that investments should generate a positive social and environmental outcome, and that's outside of any financial benefits of the regulatory requirements. So pick which one you are, and hopefully on the app it will come up and you can vote. So please vote now. We need a little countdown, don't we? That's really interesting. Oh, let's keep moving. A couple more seconds. Everybody happy? Cool, that's really interesting. I've no idea how many people have actually voted. So it could be a small handful, but typically we've done quite a few of these with various trustee groups or governance groups, and we very rarely, if in fact never, see anyone in external impact. So that's really interesting. We see a lot of schemes sitting in the comply bucket, and it's lovely to see actually that a lot of people in this room at least are moving into measure and manage, and that's kind of where we see the nests and HSBCs of this world. And the seek alpha and external impact, interestingly, when we speak to schemes or governance committees, that's typically where you might put a self-select fund to allow members to put their own personal views into play. And we've seen products in these at different areas, at different personas, but I thought it'd be interesting to have a look at where you can actually implement this ESG belief and how much does it cost in terms of the fund AMCs. And that brings me on to some of these funds that are available. And as you can see, so from Comply, we've got, actually I've put a low carbon target index up there. It could be any index fund really. But even the carbon target index fund, I mean, you're actually making an active decision to be low carbon there. So it is moving into a slightly active space, albeit with, within an index. You've got the LNG Future World Fund, which I'm sure you're all well aware of. And as you move into the sort of the more alpha generating type ESG funds, impacts and bridges fund management are actually specialists in sustainable and impact investing. We've seen other funds that are actually been created as well. So there's the State Street MSCI ESG fund that's been launched recently, and Bailey Gifford Impact Fund is actually coming onto platforms too. And you can see the different fees associated. They're very broad brush fees. I mean, it really depends on the size of scheme you are. But fund managers, I would say, are actually very keen to talk to schemes and are willing to negotiate on these fees, and particularly as these schemes are getting bigger and bigger year on year. And hopefully it shows you that no matter where you are on the ESG persona spectrum, that there are solutions out there for you. But how does this actually fit into an overall default investment strategy? So this is what a default strategy could look like. And this one that I've put up actually considers the different generations and different outcomes, and it's targeting a flexible through retirement solution. This is actually Redington's own default. We have a very small contract-based scheme at Redington, and it's run by a governance committee. And as you can see, we've got a mixture of passive and actives in there. And the governance committee, similar to many DC schemes, have to make compromises. So we have got a passive emerging market equity fund in there. Ideally, we'd like it to be active, but the governance committee is constrained by cost and availability of funds on the platform, very similar to others. But they also believe that ESG risks do exist and would like to see them going through the whole of the glide path, not just at the sort of growth areas we've got with the multi-factor ESG equities. And so this default itself will evolve over time. They've used what they can today, but when the mindset of things will change, I'll need to be reviewing this and moving it as time goes on. So the point here is don't be restricted by what's available today. Think about what do you want to do, what do you want to achieve, and set on that journey to get there. As I mentioned before, fund managers are open to have discussions, and so I think they do really want to help design better strategies and deliver better outcomes for our members. And also with the interest in patient capital, as you've seen, there's going to be a lot more movement in DC over the forthcoming years. So this is just in summary. When thinking about your investment design and what you're going to implement, do start with members. Think about what they'll need and put them at the forefront of your mind. Secondly, define what your investment beliefs are, and this is from a clean sheet of paper, and don't be distracted what might be available today, but set a defined set of principles and beliefs that you agree with, and implement them as far as you can with the products available today, knowing that things will change and develop, enables you to keep an active eye on your investment strategy. And so the key message here is don't feel restricted by product or price. Just set out your investment beliefs clearly and do all you can to meet those beliefs. And finally, I would say please just keep active, both in governance and investment. And this is one of the minions jumping on a bed. My little girl loves jumping on beds and she loves the minions, so there you go. And if you remember nothing else from the talk today, remember the minion jumping on the bed and keep active. And that's all from me. Thank you.
Lydia, Sarah, thank you very much for this really interesting presentations. Now, I'll take some questions in the room in a second, so please do get ready to put your hands up. We've got one eager hand already, but before that, I'm just going to ask a question myself. So, at the PLSA, we are focused, in fact, our mission is to help everyone get a better retirement income. So, I wonder if you could just say something about how schemes pursuing a more active strategy can help in that mission.
Do you want to start?
Well, I started before, so you should.
Oh, it's me now. I suppose from all of the things we've just been saying, it's what we're wanting from schemes, from trustees, from governance committees, is to have a real clear view of what the outcome is that they're targeting and invest aligned to that outcome and investment belief. And you can chop and change it in terms of slowly evolution, but really keep the outcomes in mind and not worry so much about short-term noise and volatility, but think about the long term, which is what we would tell our members.
I think we've got a really long way to go. Just things like when we report to members every year in their benefit statement, we tell them what the fund that they are invested in has done overall from a performance perspective, but we don't tell them how their pot has grown and the percentage they're getting. We don't, lots of people charged with the governance of schemes, whether it be on a trustee or a contract-based basis, aren't looking at actually what has the experience for individual members been across the path. Some of the reporting I've seen, investment reporting on DC default funds, because it's made up of all different bits, is completely impossible to actually understand. And I'm supposedly, an investment professional. So I think we've got a really long way to go before we actually even get the information that enables us to do a proper job for members.
Great, thank you. This gentleman here with the eager hand.
Andy Dixon, Atlas Master Trust. Sarah, Lydia, thank you very much for that. That was really interesting. Question, asset allocation. Who is best, in your view, to take that responsibility, not just at outset, but ongoing? Is it the trustees? Is it a consultant that's advising the scheme? Or is it an asset manager, a global asset manager? Is it a passive manager? Or is it an active global asset manager? Who do you think is best positioned to make those calls in terms of that overall asset allocation, not just at outset, but ongoing?
Very good question. I would say it's the person who can demonstrate they can do it the best. So my what I would hold is that trustees generally make asset allocation decisions. They very rarely measure whether the decisions they've made have delivered against the objectives or not. So it's difficult to say whether they're doing it well or not. I think they should measure it a lot more closely. And if they're not doing it well, look for someone else to do it for them. I have a lot of time for fiduciary management in contexts where trustees don't have the time or the ability to make asset allocation decisions. I have a lot of time for fund managers making what I would call asset allocation decisions in sort of broad sectors like fixed income or something like that. So I think it's where can you find proven skill to do it well, to meet your objective within the price that you can pay for it.
I would say it would depend on the scheme. Some schemes are able to do it themselves if they're big enough, got enough resource, enough governance time. Some schemes don't. And I think you have to be honest as a scheme or a contract-based solution. Do I have the time to commit to this, to make sure that we're being true to what we've set and it's achieving the objectives? Or if we don't, we find somebody who can.
Yeah. But I would find in a lot of providers, the asset allocation is built into the provision of the default fund. And I mean, I heard the other day someone had an overweight to UK equities compared to a global benchmark. I said, how do you measure this is a provider talking, how do you measure the success of that overweight strategy or not? We don't consider that to be an investment decision. We've got UK customers, so we are therefore more invested in the UK. Really? Let's not kid ourselves that providers or asset managers are actually doing a better job than trustees
not
out there.
No, not at all.
But everyone who's doing it needs to be really honest about where they are making investment decisions and measure whether those are working or not.
Yeah.
Do we have any other burning questions in the room at the moment? If not, I can go to the... perfect.
You showed a couple of flight paths, and it shows you the term to retirement, and it gets to zero when someone retires. But post-pension freedoms, only a minority of people check out completely. Therefore, are we assuming, let's say it's a uniform drawdown scenario, does the flight path stay constant in terms of the mixes to the right of the zero term to retirement?
To the right of so after retirement. I mean, this is one of the most challenging things, I think, when you're designing the fund, your default fund as a trustee, because nobody's telling you what they're going to do with your money. They don't know. If they do know, then they're not telling you. You might not be asking them. So it's very difficult to design a default that best meets that. I think at the moment, most people are still taking cash. People have big pots. A lot of people still have pots built up in DB. They might be taking cash in DC. So, I mean, trustees do the best they can with the information that they can get, but I can't really tell you what's right to do because you've got to try and know what your members are going to do with the money.
Yeah, I was going to say something similar, really. It's about understanding the members, what the likely thing they're doing. Most people are taking cash. We've seen that nationwide. Most of the time, from an investment strategy point of view, you tend to target to, say, the retirement age, whatever that might be, in a way that kind of meets everybody's needs as best you can. But there is an area, and we've been looking at it more recently, through retirement, what it means, what does drawdown mean, what might good look like for a standard member, how do we get something that fits everyone, even though it won't meet everybody's needs. It's really tough, but I think it's a conundrum we have to solve, and it will become more of an issue as time goes on.
I've had a question come through on the app. Target date and other such overlays are often relatively expensive. Is there any evidence that the risk-return profiles of such options outweigh the cost over the lifetime of a holding?
I suppose I wouldn't call target date an overlay. I see it as a different administration. So what you find in a lifestyle fund, a target date fund, is basically doing exactly the same thing. It's just a different way of administering it. And I see target date funds as a much lower risk way of administering it if you've got lots and lots of members and over the period of time, you want to keep up with different things that might be happening in investment management, bring in new ideas, change how you might deliver the journey path for your member. And fees, let's face it, everyone, people have heard me say this before, everyone gets paid too much in fund management and pension provision. So you've just got to drive a really hard bargain. And the issue, I think, probably in target date funds is there's not enough appetite for it at the moment and not enough providers. So the more people are asking for it, hopefully the fees will come down. But, keep driving a hard bargain.
Absolutely. I think target date funds do work really well, especially in smaller schemes, because it's taking quite a bit of the governance burden off them. And actually you're getting access to potentially some more interesting asset classes that you might not be able to if you're running a lifestyle. But I am agnostic. I like target date in certain situations, like lifestyle and others. It just depends on the situation. But I completely agree, drive down fees as much as possible. But I do advocate value over low cost.
Yeah.
It has to, you have to see the outcomes and the value added rather than worry about keeping it as low as possible.
Yeah.
Great, thank you. Gentleman there, Jamie.
Hi there, it's Jamie Jenkins, and although I have a policy job on in the daytime, I'm here as a trustee. So just on the retirement piece, the gentleman asked a question earlier about where you go sort of through and into retirement. And of course the regulator, the Financial Conduct Authority, is pushing for a kind of choice of 4 options based around people's sort of retirement plan, if indeed anyone actually has one of those. To me, because if I go back to the kind of point about lifestyles and target date funds, a lot of it is predicated on somebody sort of doing what they said they were going to do at exactly the date they said they were going to do it. And of course life just isn't like that at all. And a lot of what you were putting up in the graphs leads me to think, as people get towards retirement or taking money, whatever it is to them, there needs to be some kind of constant checking and monitoring and rebalancing and guidance available to people to keep them on track, because things just change so regularly. Is that the ultimate answer here?
Wouldn't it be great if everybody could have individual advice on a regular basis at a price that people could afford? That would be the panacea. That would be the golden egg. It would be fantastic. But the reality is that it's just not the case. So I think there has to be, and like to be, a balance between what computers and technology can do as well as face-to-face advice. I think this is it's a big concern I have. Not only people don't save enough, but when they do get to that decision of what they're going to do with their savings, how they manage that, and how do they know what choices to make? Do they pay their mortgage off, or do they use it to save for longer? Are they going to have any money in later life, or are they going to run out? And these are very complex, complicated issues that individuals who have never made any choices are going to have to face. And I am very, very worried about it, and that's why something we are looking at to see. And I am actually quite an advocate of a default through retirement that allows people to have, whilst it might not meet their individual needs on a broad basis, hopefully it should give them income regularly over time. Oh, sounds like an annuity, doesn't it? But without the constraints of annuity. But it needs to be solved. I just worry that we'll solve it too late.
Yeah, I mean, and I have to share exactly the same hope and idealistic view of where we might get to. I think in the interim, all we can do is try and deliver on members' expectations at the time they say they're going to, if they say they're going to retire at 65, then we deliver what they're expecting then. And if they then phone up and say, actually, I'm not going to work for another 5 years, we can very simply and without a lot of risk of error change their strategy for them individually that then aligns with the new information they've given us.
So I think we've got time for one final question, and I've just had a flurry of questions come through on the app. I think I'll choose this one, given that it references Jamie's question. It says, in the context of the excellent last question, what target date would a target-dated fund need to target? That's a tongue twister.
Well, normally what happens is a member says, I want to retire when I'm 65, so you put them, say they said that, you put them in the fund that is going to deliver their fund when they hit 65. So in my case, next year. No, joking. That's a lot of plastic surgery. But then you can, if they say, actually, I'm going to retire 5 years earlier because of something happened in my life, you move them into the 5-year earlier fund. So that's kind of how it works.
Yeah. I have nothing more to add.
Do another one.
Great.
That was quite.
Well, I'm afraid we have run out of time, Sarah. I'm sad to say. We could go on all evening, but I assume people want some drinks. All that remains is to thank Sarah and Lydia in the usual way. Thank you for a great session.